Hello, fellow Rebel Capitalists. Hope you're well. I'm here with my good buddy, my new good Bitcoin friend, my good Bitcoin buddy. We'll go that direction. Eric Yakes, thanks for coming on the live stream, buddy, and having this discussion. I'm really looking forward to it.
Thanks for having me, man. I think this is just a really nuanced discussion that we need to get into, and it's going to add a lot of value to the TradFi people as well as the Bitcoin community. And I'm jazzed that we're talking about it. I think sometimes it gets like a bit technical, and people don't understand some of the semantics behind different things. And my general idea is I want to try to explain things a bit more fundamentally, try to avoid getting away from the technical discussion where possible.
Yeah.
But yeah, I'm excited.
Yeah, I think that the Bitcoin community understands the broad concepts and the benefits of healthy deflation. But there's a lot of nuance that you outline in this paper that you did about a month or two ago that is absolutely fantastic. And we're going to reference it here. Josh, if you could put the link to Eric's paper in the chat so everyone can access it, I would strongly suggest reading this. It's about 30 pages. It's not difficult to understand. You can get through it in a couple hours, something like that this weekend. But if you really want to understand not just Bitcoin, but just how the creation of money has worked over the past couple hundred years, and a concept that I always talk about, free banking. This is, I think, the best resource that you have at your disposal right now. So, Eric, let's start by going over kind of a couple of my pet peeves with the Bitcoin community, and I've been really trying to explain my ideas, probably not too well on Twitter. But one of the main selling points that I see is that there is a limited supply. So you got 21 million, that's it. And I think a lot of people that don't understand what you understand because they haven't read your paper, they just think to themselves, okay, if there's a set supply, then that means that Bitcoin has to be deflationary. They say speak in terms of certainties. And that's when I start to get scared. And I say, well, wait a minute here. You got to think in terms of probabilities. And just because there's a set supply of Bitcoin or gold or whatever, it doesn't necessarily mean that we get this type of healthy disinflation or deflation that you're expecting here. And so in my position there is you've got a set base layer of money. But what we have seen throughout history is that there's always IOUs that are built on top of this. And we go back to 1800 Babylon, and, let's say they're using a set number of gold coins. Snyder would call it ledger money, where you've got, a couple vendors, a couple merchants, and they don't have the gold coins. So the one guy sells the other guy a bushel of wheat and says, okay, you can just go ahead and pay me in a year. And they've got an IOU. And at a certain point, those IOUs can actually get traded as though they are quote unquote money. And they definitely expand the rate of purchasing power, which would lead to an environment potentially of prices going up even relative to that base layer. So if you want to maybe start there with the 21 million, do you agree with that assertion that this means that we have to have prices always going down, or do you think there's some wiggle room there?
Well, I guess you mean in terms of having like an account-based ledger type system. Does that mean that that'll be a deflationary? I think I'm a bit confused.
Yeah, so let's just say that we went to a Bitcoin standard and there was 21 million, you got a fixed rate right there. And so let's say we move into, I think most Bitcoiners would say, okay, well, that's going to take us into a full reserve system. And I would argue, if you look at history, we've never had a full reserve system, and there's a reason why. And just using that example, because we have ledger money, that's just a very crude example of that. But you always have a need for the money supply to be elastic to a certain degree, at least the broad money. And so to think that, we're only going to have functionally, and I get it, there's 21 million base Bitcoin, but functionally, if you have fractional reserve banking on top of that or full reserve, you're going to have the extension of these fungible units, these IOUs that would expand the money supply above 21 million. and would allow for inflation, potential inflation. And again, I think that this is what, at least the pushback that I see mostly on Twitter, and that I have a hard time with. So I'd just like
Yeah.
to get your views on that first and foremost.
Yeah. So I think that I definitely don't think it's, to your argument around the historical side, when I was first digging into these topics, I definitely was sitting in that camp where I was like, okay, we've never seen this in history, so why would it be different this time?
Yeah, yeah,
What would prevent any sort of derivative receipt from emerging on top of, a commodity, synthetic commodity money like Bitcoin? And that's complicated. I don't really have certainty on any of it. But that's like the key step when we think about the emergence of, I guess I'll take a step back to your point, like in more primitive systems. When we had ledger-based systems and we had these paper receipts that started circulating as money throughout the economy, there was a lot of advantages that provided over a form of commodity money. Now, of course, we also had systems where we would just trade gold coins for extended periods of time, but it was once we had innovations such as the printing press and double entry bookkeeping and the telegraph all emerging. Paper money was very efficient for trade all over Europe, and that was really important. So the key distinction was that paper isn't scarce, so we needed to back it with something that was scarce, so it still maintained that property of scarcity while also having all these better properties for being a medium of exchange. And the question is whether or not like Bitcoin's innovated a lot of those things away. Are there still issues? Does Bitcoin have the same issue of lugging it around, like, trading gold bars and gold coins? And that's one argument against, is that, well, if you take Bitcoin and you look at, innovations like the Lightning Network on top of it, and Lightning Network isn't perfect. There's a lot of limitations to whether or not it will emerge globally at scale, but I see it as certainly the most viable opportunity, and I definitely see it as a possibility that could emerge in the future. So if we were to like conceptualize that, we have a base layer form of money, and we also have a very efficient form of payments, which instead of credit is actually like time lock collateralized. That actually solves a lot of the problems that needing a derivative receipt would actually need before. And in that, which is just one aspect of it, right? That's just one aspect of whether or not we would need credit or derivative receipts. But when I think about it from that perspective, I'm like, okay, well, that solves a lot of problems. But then the question becomes, well, why else would we need some form of derivative receipt? And there's some arguments against that I would see emerging is the fungibility aspect of Bitcoin with its privacy, and how that's one of the key limitations to it right now. And we have certain innovations that are emerging that are ultimately creating a form of derivative receipt, like the Fedimint protocol, for example, that is that's something where if people ultimately are circulating derivative receipts for the sake of privacy, that's kind of the key takeaway. We get the benefit of privacy from using it. There could be an emergence of fractional reserve institutions due to that. It opens the door for it. But then, to expand on a lot of that, where I come out is it gets into more of like the economic theory, and, whether or not we would see it as something that's very beneficial. And I think that the way that I kind of look at that is, what's the benefit of having some form of fractional reserve or credit expansion that's inherent to the money supply? And I think that this concept of like elastic money is, it's important, but I think I don't want to confuse people between, credit being a part of the money supply or being external to the money supply, because we could have a full reserve system, or we could have a completely peer-to-peer economy with no intermediaries. Like, not saying that will happen. I'm just saying, like, let's theoretically think about that possibility for a minute. If we had like a totally peer-to-peer economy, there's no intermediaries, then we could still have credit by, somebody's savings being allocated to one of their friends within their community as, a loan in some form. That's expansionary. Now, whether or not we want to make arguments that would be expanding the supply of Bitcoin, or whether or not we're expanding the economy, we're creating some form of productive enterprise that we expect to be valuable in the future and to ultimately pay back that liability we've created for ourselves. That's separate from the question of, fractional reserve banking systems with intermediaries. So like that's kind of like one end of the spectrum, is to think about it in a simplified format of like a peer-to-peer economy and what that would look like. And then I think the next step is like, okay, well, if we are using intermediaries, and I think we will, unless credit due diligence is somehow innovated away in the future, you're always going to have individuals who are specializing in some form of intermediation to fulfill that function within an economy. Otherwise, we'd have a bunch of people who aren't very good at assessing credit risk. Doctors and lawyers aren't going to be doing that all the time. And when we have intermediaries like that existing, then it becomes, okay, well, if we are depositing Bitcoin within this, will it be a viable model for them to somehow, get that derivatives receipt that they're using for their lending instead of just Bitcoin? And if they are able to get a derivative receipt out into the market, then it is possible they could start creating a fractional reserve system. In which case, the question becomes, will that system be sustainable? But like sitting on this point for a second, so the question becomes, will people on a Bitcoin standard, if Bitcoin's global money, um, will they ultimately want to borrow Bitcoin versus some other derivative receipt? And I think that, to a lot of people in the Bitcoin community, the answer is pretty quick. It's like, no, I want real Bitcoin. Why would I want to trust in a receipt? And I think that when you get into, people who are either less educated or people who just simply don't care, um, there is we're going to put some of these economic theories to the test, I think, if we actually had a free system like this emerge, because the idea that we'll find some sort of optimal level of credit within an economy by lending out these derivative receipts in a fractional form, that system only sustains if it provides economic value. And that means that we are creating legitimate enterprises that will not cause these institutions doing it to go insolvent and for the system to structurally crumble within a period of time. And I think that, we've seen in history how free banking systems like that have existed for a long period of time. But I also think that, and I'll keep this on the side, but I think that there's like some technological innovations that might make it so much more efficient in the system that it'll actually be very hard from a competitive perspective to run a fractional reserve institution. When we look at some of these like redemption attacks, like not analogous really, but like, somewhat comparable to, Binance FTX debacle, people, different competitors attacking each other's credibilities and trying to cause some form of bank run. That'll be a lot easier on this type of system, especially with innovations like flash loans, where you can scale leverage to a very high degree for like a verifiable on-chain arbitrage trade. That kind of stuff will make it a lot harder to actually do that. But anyways, getting back to the point, I think that when we're expanding that money within an economy, we're putting to the test whether or not that expansion of fiduciary media is really creating any sort of economic value by having that extension of credit and not just base money. Because if we think about if there's just Bitcoin and there's no credit at all, then there's a lot of valuable enterprise that won't get financed. It requires scalability to start some of these, very major projects that make our lives a lot better today. So that's one end of the extreme. The other end is fiat central banking, where we're pushing credit to like these very far ends of the other at the end of the spectrum, and we're creating a ton of malinvestment from doing that. But if we had a natural emergence of fractional reserve media emerge, and it's producing valuable economic enterprise to where they can ultimately pay back their depositors, well, that'll be a strong incentive. And the reason depositors would want to accept that is if these banks are using a form of fractional reserve and they're like, okay, we're able to outcompete, say, full reserve banks because we are, lending in all these other projects that they otherwise could not. And that's paying us a much higher return. We can pass that back along to our depositors. But once again, why would anybody want to borrow it from them in the first place as opposed to direct Bitcoin? And I think that, we could see schemes like incentive schemes where they're like, okay, you could accept Bitcoin for this loan, or you could accept our fiduciary media token or whatever it is. And we're going to provide you better terms on that token. Why would they do that? Because they're ultimately generating some sort of economic yield for it, at least in the long term. In the short term, there's a lot of reasons they could do that, and they could be trying to scam people. But nonetheless, it's possible that they could do that. And if people want to also use a receipt to like have some form of privacy, that could also be an interesting way in which it emerges. So like those are some of the nuances that I see to it. But the last point I think I want to make is that where I got is that I don't think credit has to be it doesn't have to be part of money. I think it's possible that we could have some sort of full reserve intermediaries where they're really acting as some sort of credit fund that people are allocating to and earning a rate of return. And that's a way of extending credit. Credit is being, delivered within Bitcoin, and there isn't a fractional reserve form of media that exists. The way that I break that thinking down is the primary reason that I don't think we would have that, or I guess it would be advantageous, at least from the intermediary's perspective, to want to use fractional reserve, is that they would rather be less limited. So if we go back to that peer-to-peer idea, credit extension is kind of limited to the trust that people would have in their community networks. Your neighbor Bob wants to go start a grocery store. He asks you for a loan. People aren't going to lend to people that they don't know in that type of a system, at least within this confined example. And then when you move to like a full reserve system, what is the degree of credit restricted by? It's restricted by the amount of reserves in the system. So you can extend credit a lot, a bit more, or at least it would create it easier way of extending credit a bit more. Theoretically, peer to peer, it could extend that far, but it likely wouldn't because people wouldn't trust that much. So those are like the first two, and then the third is like, okay, what if we have a fractional reserve system, like a free banking type system, and then that I'd say it's limited by the solvency of the system itself or the institution itself. So going back to your point. I think that a key distinction around if we do have some sort of expansion in fiduciary media, so we have Bitcoin banks all get set up, they all get people to trust their receipts. They all start saying, okay, we can start printing a bit more receipts than we have in Bitcoin. That'll cause that credit expansion to move. That'll cause prices to rise. But like a key element of free banking systems is that there's a natural limitation to the amount of credit that could ultimately extend through these systems. And that's based on the principle of adverse clearings. If you extend credit too far, then eventually you're going to go insolvent. That's kind of the gist of it. So there's this natural limitation. So you can think about it from the perspective of, okay, so we have this form of money that's expanding based on credit. That's going to cause prices to rise. But once it reaches equilibrium, now we're kind of at a steady state. And now the money supply is, say whatever it is. If we have 50% Bitcoin reserves, then we effectively doubled it by expanding. Prices adjust to that. And then now we're sitting in this like fluctuating level of where, we have this certain level of credit that exists naturally. If anything happens too bad, it'll contract a bit. And if we go into a slump, it might expand a bit, but we're kind of sitting in an equilibrium level. And that's where I'd say we would once again be kind of confined to that fixed level that Bitcoin has of 21 million. So if Bitcoin supply increases by 0.01%, then credit would expand by that multiplier. So like in that example, Bitcoin, the reserve levels increase 0.01%. It's, doubling that amount. So it'd be 0.02% increase in like, the total monetary expansion that would occur.
So instead of 21 million, you'd have 42 million or whatever the equilibrium point was.
Right. So like, it's not like fiat central banking where we have this, we're going to expand until we have a political regime change at some point in 70 years or whatever it is. And like, that's kind of what history tells us, is that if we do push credit to these unsustainable levels, eventually, it comes down to some sort of structural uplifting of the society. And so like, they're all limited in different forms. And the question is what limit does society ultimately choose in a free market? And where I come out on that with people in the Bitcoin community, with like Austrians, there's some Austrians that thought, it's fraud to do that. And while I can see that side of the argument, what I think is much more important is to allow the free market to choose and allow people to choose, because, to your point, we haven't really had much, we haven't had any sort of natural full reserve system emerge throughout history. When these systems emerged, it was always because they were kind of like relegated in some form when we saw those types of depository institutions. So it's, because of that, I think that if we do see, this, if we do see something from like the ethics side of it, where we're like, okay, would we rather have a fractional reserve thing emerge because people are choosing it? Yeah, I totally would. And I think it's important that people maintain that. And I think that a lot of that can come also from the industry accepting bottom up standards and understanding, kind of the reality of how some of this might build out, rather than, what they want to happen.
Yeah. So what I need to do there is go back and explain exactly what you said.
Yep.
Because there's going to be a very small percentage of people who followed that. But before we get there, I'll ask one quick question. And going back to free banking in the 1800s, why didn't I get why people chose banknotes? They're
Yep.
more efficient. You don't want to carry the gold around in your pocket. Totally get it. Why didn't people choose full reserve? Because if there's demand from the market, obviously it's going to be filled by banks. So why did people prefer fractional reserve? Therefore, that was what we saw flourish in the 1800s.
Yeah, I think that it was. Now, I think that in those systems, information transparency was much lower. And that's one reason. Certainly, I don't think that everybody is running around like, here's how our banking system works, and we're happy with that. But I think that there's two sides of it. There's the consumer demand. We want somebody to store our resources with. We want to use the derivative receipt because that's easier for payment. And we want to, some of them are like well aware of the risks of that. Some people probably aren't. And then I think it's more on like the supply side are the incentives for that, because when you're a bank and you can issue some sort of derivative receipt, then assuming you're a full reserve, you have to pay your depositors a rate of return to attract them competitively.
Right.
But if you can issue some form of fiduciary media, then that is a much higher margin form of return for you, because you don't have to pay any depositor back for that. And what that allows you to do is gives your depositors a cut of it, which makes you be able to lend at higher rates than the full reserve. So by that competitive dynamic, and because it was somewhat sustainable and like a free market system, like free banking back then, that made it a lot more attractive for these to emerge. I don't think anybody was going to the bank like, I only am dealing with fractional reserve banks. It wasn't really a consumer thing. It was more of a supply side thing where they're like, oh, we can earn, more money
Yeah.
doing this.
And my point there is that that's exactly what I think would happen if you
Mhm.
went to a Bitcoin standard. I would expand on a few other reasons, but that's my biggest thing that I like to point out is, if full reserve was that optimal, if depositors demanded it, they would have demanded it back in the 1800s, and
Mhm.
we just didn't see that. So you have to ask why. And to your point, it's because they're getting a higher interest rate, so they get accustomed to these IOUs, which you call the derivative,
Mhm.
and a banknote, and they say, "Hey, well, we've been using these banknotes for 5 years. They seem to be working okay. Let's just keep using them. And if I have to use these banknotes and get, let's say, a 5% return on my money, I'd prefer that than to get a 3%, knowing that this bank is full reserve." And
Yep.
so the idea that in the future, if we went to a Bitcoin standard, it would 100% guaranteed be full reserve, because no one in their right mind would choose a banknote. That's where I think that thinking is flawed.
Right, right, and I definitely agree with that. I was on a panel down in El Salvador with the CEO of River Financial, Alex Leishman, who he put this pretty well. He's just like, people are very poor at assessing risk, and they have short memories, and that's one of the challenges. I think that a lot of I think that Bitcoiners in the community will often assume that. A lot of people think similar to us, and that like if we get to hyper Bitcoinization, everybody's going to be as educated as we are on some of these topics. And I think from a consumer perspective that may not be a reality. What I would like is for this system to build out in a way that it's so efficient, information so transparent, and the end product is so of like a full reserve type system is so valuable to consumers that it actually outweighs the demand for fractional reserve. And that even in that scenario, though, I think that we'll still see fractional reserve type institutions exist at like as like an edge market, like
Yeah, and
penny
also
stocks or
too,
something.
we talked about the depositor side, but we didn't talk about the lending component of it. Would you rather have a 20% mortgage or a 5% mortgage? And that's because if you want full reserve, you're gonna have to pay a hell of a lot more for that mortgage. And from a consumer standpoint, I think that impacts it as well. I want to kind of shelf that though, because that's when we start getting into, okay, how do we go from A to B? And one of the big hurdles there in overcoming the dollar network is that, yes, there are many benefits to Bitcoin. One of the benefits to the dollar is that it's a hell of a lot cheaper, just a hell of a lot cheaper. In fact, I did a Twitter poll the other day where I said, would you rather, for your next home purchase, assuming you have to get a mortgage, would you rather buy Bitcoin or borrow Bitcoin at 15% with a 10-year mortgage, or would you rather borrow dollars at, let's say, 7% with a 30-year fixed? Because the 30-year fixed rate is something from the government that's subsidized. You're not going to get that in a free
Yep.
banking system with Bitcoin or gold or anything. And of course, I forgot what it was, maybe 70 or 80% of the people said that even the Bitcoiners said that they would prefer the dollar loan. So then it's like, okay, well, how do you and if we know
Right.
that lending or credit is future demand for the dollar, then that kind of enforces that network. But before we get to that point, let me back up here because I know there's a lot of people that we've kind of we've sprinted by here. So what happens is you've got, let's go back to the 1800s. You've got your gold bar, and it's difficult to carry around. It's a pain in the ass, and it's you can't sit there and shave off pieces of gold just to barter. You've got these little coins, but you don't want to be robbed or whatever. So it made a lot of sense for you to take your gold and give it to the local institution that seemed very safe, and they would hold it for you. And then what they would do is they would give you a banknote. So back in the day, the banks just issued their own notes, just like that green piece of paper that you have in your back pocket. So when Eric is talking about what'd you call it, Eric? The bank derivative or the derivative?
Yeah, like a derivative receipt, something
Derivative
its
receipt.
value is derived from an underlying asset.
Yeah, sorry. So that's what he's referring to is the derivative receipt. This is the banknote, the IOU that the bank gives you saying, hey, we owe you this amount of gold. And what would happen is the general populace would say, okay, well, we trust this bank. And therefore, if you give me that bank's note or that IOU, I'll go ahead and give you this good or service because I know someone else in the community is going to accept this banknote. So under this system, it doesn't necessarily mean that we don't have credit. And this isn't fractional reserve yet. So what can happen is that bank can say, okay, well, some of you have a demand deposit, and we're going to go ahead and charge you for that. But then other people will offer a time deposit. So we're saying we're going to go ahead and you're going to lend us your gold or your Bitcoin for, let's say, a year. And then it's like a balloon payment. We're going to give it back to you plus, let's say, 10% interest. But we're not going to, but you can't access it between now and the next year. That's the deal here. That's the contract we have. So then they would take that Bitcoin or gold and they would lend that out to someone else at a higher interest rate. And then at the end of the year, but they'd only do it for a year. So you'd have the maturities would match. That's key. And then they would get that gold back from the person they lent it to. Hopefully they would create more goods and services. They would get the interest, and then they would give that person the gold that they lent them via that time deposit in the first place. This is full reserve banking with the extension of credit. This is how it would work. And now we move on to fractional reserve. And this is when Eric starts talking about fiduciary media. Or another word I think that Mises used was creation credit or
commodity credit and circulation credit.
Circulation credit. That's what it was. Yeah, thank you. So this is when the bank says, okay, great. We've got these time deposits. We've got these demand deposits. But what we're going to do is we're going to go ahead and create more IOUs, more banknotes to lend out to people and charge interest than exists with the underlying asset. So it's not a 1-to-1 ratio. Then you have like 2 banknotes for every 1 piece of gold. And this is fiduciary media. And this is for a lot of Bitcoiners and for the Austrians who favor full reserve. This is where they draw the line. That they think that in and of itself creates consumer price inflation, and it also facilitates the boom bust cycle. And I think that probably most of them would acknowledge the fact that this can lead to faster growth, but they would also say that that cost or that benefit is combined with an even more extensive cost from the standpoint of having to pay the fiddler by the misallocation of resources and malinvestment that's created by the fiduciary media in the first place. So I think that's kind of what gets us up to where we are in the story with the debate. Would you agree with that, Eric?
Yeah. It's just this trade-off between how much growth do you want to incentivize in the economy to how much stability you want to have over the long term.
Yeah. And my big sticking point with the Bitcoin Twitter community is that, number one, it's really not 21 million. It is, but so many, and I think the sophisticated people get it, but I think there's so many people in the community that don't have that level of sophistication, and they're buying it just because they think it's fixed and it's always going to be fixed, and we're never going to have fiduciary media, and there's just a 100% certainty of this. And then the other thing that I push back is they say, well, you could always just use Bitcoin as no counterparty risk whatsoever, because you can always just store it in your back pocket. And that's what everyone should do. They should just store it in their back pocket, self-custody, and we'd never, ever have any problems for the rest of our lives. And then I push back on that and say, okay, well, then you're not going to have any liquidity. And, to your earlier point, the average Joe and Jane is not going to be able to do due diligence, let's say, on the manufacturing company in Vietnam that needs a bridge loan, right?
Mhm.
So eventually you're going to get some people that are experts in that, and they're going to say, hey, there's demand for these loans, and they're going to pay 10%. So I'll give you 5%. If you take your Bitcoin from self-custody, give it to me, and then I'll manage it. Whether you want to call that a private equity fund, a hedge fund, a bank, that's most likely where we would go with it based on the probabilities. So those are my two big sticking points, because I think a lot of the Bitcoin community sees the self-custody and the full reserve as a certainty, that there's
Mhm.
no other option, and this is just inevitable. It's just a matter of time. And I think we probably both kind of disagree with that conclusion. Now, assuming that's correct, then I want to move on to the next thing, which I think is a really interesting idea. Is how we get from A to B.
Yeah, what I do want to say is I definitely don't think it's a certainty, but I think when I started off, I was leaning more the direction of like, oh, we're probably going to see a good amount of fractional reserve. The more I get into the research, though, and when I understand Bitcoin at a more technical level and some of the emergent layers being built on top of it, and how some of those applications will ultimately be utilizing it, I think that there is a strong argument that a full reserve type system could actually exist and be a thriving system, because now the like one key point I'll say quickly is, because we have this payment network like the Lightning Network, um, individuals can actually earn routing and liquidity fees by allowing that network contributing their hardware and their capital to it. They can actually earn a rate of return, and it was Nick Botti, Layer Money, who was making the argument that that's going to be kind of like this new emergent capital markets risk-free rate that's emerging in the Bitcoin ecosystem. But the point is that think about it like a payment system that exists today. It would be like the fees. This isn't directly analogous, but it would be conceptually similar to if you were receiving, Visa's charging X amount of fees to be able to use the network, and then it's paying a dividend to the people that are like supporting it. And that's kind of this idea of it being like a distributed network of users, which is interesting because that makes there's a risk-free level of not perfectly risk-free. There's still technical risk of like storage of it and things like that. But there's a way to earn a capital, a rate of interest on your capital, and without assuming counterparty risk that's inherent to the system, which will make full reserve a lot more compelling and a lot more competitive against the rates that fractional reserve is ultimately, offering people. Doesn't mean it's going away, but there's a bunch of other things, and we can move on. But yeah, I think that there's a lot of things that I start to lean more and more that it actually could be viable that a market would choose a full reserve system. It could be, potentially there's a stronger probability that I see of that.
So if you've got a fixed amount of money,
Yeah.
and there's going to be liquidity needs, there's going to be capital needs in order to create more goods and services.
Hmm.
And I think people have to remember that money in and of itself is not deflationary. It's the production of more goods and services. And if you start just at a very simple economy, excess productivity is capital. But once you are able to expand the capital through fractional reserve banking, that can accelerate the productivity and therefore accelerate the creation of goods and services, which ironically will bring down the price. So if you have that fixed amount of money, let's say, you do get into kind of a situation where you've got two choices. Either there would be a business that would not be funded because there just isn't the money available, especially in a recession, where if a lot of the money was in people's back pocket, people would not be wanting to lend that money unless it was like, let's say a 50% interest rate, in which case it might as well not be available in the first place. Or the interest rate would have to attract enough savings in order to fund these projects. And therefore that interest rate could be extremely high. Let's say it's 20%. Now, I get it. You say, George, well, that's going to be fantastic because then only the best businesses are going to be funded. Okay, that may be true, but you've got to understand what you're doing there is there are going to be several businesses that could have been funded, let's say at 10%, that would have been very viable and would have been incredibly sustainable and would have made our lives a lot better and would have ironically created more goods and services that would have put more downward pressure on prices themselves, which would have allowed the purchasing power of the fixed supply to be utilized without fiduciary media in the future due to the divisibility of that money itself, right? Because that's the other option is, like I said earlier, is you've got this entity that needs $1 million and the bank says, well, we don't have $1 million, but we have 1 million quarters. And they say, well, unfortunately, that's not going to do me any good because the purchasing power that I need right now is $1 million. They say, well, you've just got to wait till prices come down, and then we can give you the 1 million quarters to buy the machinery, let's say, that you need. And that's going to take a lot of time. And then also, it would be a lot faster if they could have access to sufficient capital to create those goods and services. You see, so it's a little bit of a paradox there. And this is another reason why I think that the free market would definitely gravitate towards this type of system, even if logistically, with the Lightning Network and all the other layers that you're talking about, would make the issuance of credit very efficient.
Right, and which I think also, I think that makes an argument for credit existing, kind of like external, not fiduciary media, and having it not be fractional reserve, like because that is one of the advantages of fiduciary media as well. Is it's just, it's kind of like being able to issue stock by selling into a secondary market versus having to go through an IPO. And I think that's kind of one of the interesting distinctions. But I don't think it's a primary one. I mean, the primary advantage of it to at least institutions is it's reduced limitations, and primarily to governments is that it's reduced limitations on the expansion of credit. But yeah, I mean, I agree that I think that that when you have this when you have the expansion of interest rates, the way that I think about it is at any given point in time, everybody's kind of got ideas in their head about, what would be a good idea for a business to be set up tomorrow. And there's some sort of priority in which those will be financed. And then at one end of the spectrum, we could say in a system of no credit, well, only people who have savings are going to be able to start businesses. And that'll limit quite a bit of valuable things in the world. And then at the other end of the spectrum, we have the fiat banking system, which has expanded credit so far that, anybody with a horrible idea can get financing for it. In the middle is somewhere we want to be, where we say, okay, there is valuable enterprise that requires credit. It doesn't really have to come through a fractional reserve system, but maybe the ease at which it exists and some of the value that comes from it will ultimately be how it emerges. But there's potential that isn't the case. But if the value that's coming from these projects is something that needs to be determined at a market-based level, and when we're if we were on a Bitcoin standard and we were dealing with a deflationary asset, and we did have a full reserve, let's say, and credit was much more limited, interest rates were much higher, maybe that would be enough to finance what we'd want. And it's just like, it just comes down to this idea of what is over investment, what is under investment. It's these theoretical ideas that we achieve as a society some sort of consensus over, or at least the people in power do. And I think the just thing there is for it to emerge in a market dynamic and allow that to just be fleshed out, and the economy will go where it goes. But certainly it would be, this is a very distinct idea from the constraints of fiat central banking, and there would be a lot of things like SoftBank based projects that would never be financed in the first place. And I think that would be good.
Yeah, I think that a lot of the people in the Bitcoin community, they go from one extreme to the other as though it's binary, meaning that either you have full reserve or you have what we have today. And my point to them is no. There's something in the middle called free banking, where these banks are not bailed out. There is no government involvement. There is no central bank. And if they issue a loan to XYZ Corporation, that it's on their balance sheet. They have to they have to reap what they sow. And therefore, they're going to be highly incentivized to issue that new credit to an entity that is going to have the ability to pay them back, and most likely pay them back by creating goods and services, by creating wealth, by creating value that the overall community or creating a good or service that the overall community values more than the purchasing power that they've accrued by producing more than they consume. And that's kind of the middle ground there that is far from perfect. Absolutely not even close to perfect. But another thing that I always say is that, if you've got a perfect money system or a perfect money, let's say that's gold or Bitcoin or whatever, if it's controlled by imperfect human beings, it's still going to be imperfect. It's just, you can't, Bitcoin doesn't fix human flaws.
Right.
And although it may be a little bit better, I just don't think we get around that.
Yeah. And I think that, the I agree, the incentive is always going to be there. But nonetheless, I think that there's a lot of potential for it to, potentially build out another way.
Yeah.
And
So let's, Eric, I'm sorry to cut you off there, but let's think about that, because this is something like when we get to a world where everything is priced in Bitcoin, I can really get my head around that pretty quick. And I kind of, do go, okay, this would probably happen here. This would happen here. This would happen here, just based on what's happened in the past. But where I really struggle is how on earth do we get to where we are today to this world? There's that big gap, right? And I use the example of with Josh just saying, everyone's talking about, well, when we live on Mars. Okay, but how do we get from A to B? It's not that simple. You're talking about a very complex thing.
Right.
And that's where I see the dollar network. I think the thing I struggle with the most is how does something how do we price goods and services in Bitcoin if people are not willing to borrow it? And I know that kind of sounds crazy, but if you really think that one through, it seems very difficult to me. And if people are still borrowing dollars, that's creating that future demand for dollars. That's increasing the strength of that network. And one other little thing I'll say here is I did a story earlier today about this report that the BIS just came out with on the off-balance sheet dollar liabilities for global entities. They put them in non-bank and banking entities. And just non-bank outside of the United States, you're looking at about $40 trillion. 40 trillion. And then let's just assume that the global monetary system has, on and off balance sheet has about 100 trillion in circulation. They projected that about $5 trillion a day circulates. It turns over. And so I just think, okay, you've got Bitcoin right now with a market cap of, I don't know, let's say 800 billion or something like that. How on earth do we get to where it could handle the needs? Let's just assume for a moment that it was $2 million a coin. But then how does it get to $2 million a coin especially if the price stays stable and doesn't go up exponentially? Where do you get that mass adoption? And then the next thing I think about is, okay, well, if it's infinitely superior, then you would get that mass adoption. But for the average Joe and Jane that just wakes up at 6 o'clock in the morning, goes to work, takes their lunch break, picks their kids up from school, comes home, kisses the wife, enjoys dinner, and goes to bed and does it all over again. I don't know how Bitcoin is exponentially superior to the current debit card they're using. So I know I've given you a lot there, but that's just me kind of thinking out loud.
Totally. Yeah. I think that, to your point, Bitcoin's going to be adopted by the average Joe and Jane when it's just something that everybody else is using at that point. And I think that we need people who are thinking about these questions and who are driving all this forward. And that's what a lot of, the Bitcoin community was like we're the adamant people who wanted to push this very early on, especially when it was like totally uncertain. Now we've kind of gotten to a scale where it's like, okay, this is real. Stopping the network, it's kind of like a virus that's already spread, and you can't really turn it around at this point. And once it got to that scale, it's kind of like, okay, this is a lot more real. And then that's when a lot of people from the TradFi system at the institutional level started really thinking about it a lot more. And while they still lack quite a bit of understanding, I think there's a lot of influential thinkers who are starting to support this whole idea. And I think that that's where a lot of the adoption will probably come from, at least in the near term. And that said, I don't think that there's I think that it's going to come in a variety of different ways. Where I see it getting to a global level is going to be kind of like a bottom up movement through some of these third world countries that just want to opt out of the dollar system and have, the value from remittance payments that they can capture from utilizing its network. And while they want to use dollars currently, I think that as it expands, it becomes more and more appealing to them.
But why does it expand and become more appealing? I want to take it down to the simplest form. If I have let's say I sell shoes or something like that.
Yeah.
I'm just trying to think through what would prompt me to price those shoes in Bitcoin. Like so right now today, when my input costs are, let's say, dollars, and you got that FX risk.
Right. And it's just like how many people in these countries are actually, sitting there, dealing with their FX risk. And some of them could simply start to build out circular economies. I'm not saying today. I'm saying that in the not so distant future, I see that as a bit more viable. But in terms of like the medium exchange function, I don't think that that's really the primary driver of where we'd see adoption in like non G7 type economies. I think that where the primary driver is going to be more for the store of value function and for the disintermediated payment rail function that sovereign institutions are going to see. So if you are, put it simply, like you are, at the beginning of this year, we saw Russia get sanctioned.
Yeah.
And, we have the whole dollar
I think
system.
Is a great argument, by the way, the no counterparty risk. Yeah.
Yeah. I think that that's kind of the primary driver for a lot of these smaller economies to say, hey, we're doing X, Y, and Z. Maybe we're, a large economy, maybe we're a bit smaller. It was signaled to the entire world that with these sanctions that the US is, in somewhat of a point of desperation into what they can actually do, and they're going to economic war with some of the larger economies, and you have to play by their rules. If you're using their currency and if you're using their payment systems, that you're going to have a lot of problems if you don't act in accordance with the US. So it's a form of freedom for economies to be able to opt out of that, and I think that will make it a very strong argument for adopting it in some form on a small scale is a reserve asset. Now, gold will actually win in a lot of ways for that too. And Bitcoin doesn't have, or the two primary reasons that you'd want to have a reserve asset is because it has a stability in price and it's highly liquid, which is what Bitcoin's currently lacking, which it gains with scale. But it also has the advantages of being able to transport it and not have to store it and to verify it very easily, have like ease of which you can transport, store, and verify. And that'll be huge. And being able to do that in a permissionless way, that'll also be huge. So I see it as kind of like the proportion of gold that ultimately benefits from economies that want to opt out of the dollar system, which has been happening for a long time. If we look at reserve balances, I expect that that's probably going to continue to increase as we start to see more of this multipolarity or these increased tensions between the East and the West.
Yeah.
And if that continues to increase, then there's some percentage of that market that's going to come to Bitcoin. And maybe that gets it to, say, a few $100,000 level of asset class. And maybe that reduces its volatility a little bit less. And maybe that encourages a few more sovereigns to want to adopt it in a larger way. And I see that as kind of like the primary snowball to building out that store of value function. And then, it is somewhat of an experiment, right? Like, when's the last time we would see an economy that's scaled a commodity-based money to the point where we're actually determining what it would look like as a medium exchange? It's not like we have like a ton of data to really look at. We can look at the Roman Empire, but that was all being manipulated and diluted through coin clipping and coin dilution as well. So it's like really hard to actually for us to say like, oh, Bitcoin needs to hit this, value, and then price stability is going to be high enough to where its medium exchange function will start to really take off. But yeah, I'll stop there.
It seems there's a bit of a paradox there because to get to more and more people adopting it, even if they're central banks, you've got to reduce the volatility. But the only way you reduce the volatility is if you get more adoption.
Well, I think, yeah, the only way to reduce the volatility is to get more adoption, but it's just like anything that gets bootstrapped, like when a social media platform becomes popular. It's just something where, to make it more valuable, you need more users. And, when you get more users, you want to make it more valuable. But it's a similar concept. And as long as it's incrementally doing that, I think the crux that it boils down to is what other utility does it have other than that that's going to continue to increase adoption for it? And that's the ability to permissionlessly transact and hold an asset, and being able to tell another government, F off if, you disagree with them in some form, at least at, a minor level. But yeah, I think that that's kind of the crux that'll continue to increase adoption.
Okay.
And then that adoption gets easier and easier to
Yep.
keep moving upward as, it starts to move exponentially.
Okay. Let's go back a little bit, because you use the term commodity money. Now, when I think of commodity money, I think of money that has a use case other than money. And so how does Bitcoin fall into that category if the use case is, or the only use case is money, and it has no use case in the real world, in the tangible world? I think that's the best way of saying it.
Yeah, and that's a fair point. From like a non-monetary perspective, which I think is one of the biggest benefits of Bitcoin. I'll actually make a point about free banking on that. But Bitcoin, I use the term commodity money because it functions economically like a commodity for its monetary use. It's a synthetic commodity money. When I write about it, I'll call it that. But yeah, I mean, there just isn't really like a word for it other than that. I mean, but
okay.
yeah, it doesn't have, it's not used in electronics like gold, obviously, and things like that. But if you were to read into the free banking theory, with like George Selgin and Lawrence H. White, they're, the kind of the primary advantage of, well, I guess I would say it as one of the primary issues that you have or you had in free banking with gold, is that because gold had non-monetary uses, that meant that its supply and demand dynamics were subject to shocks because of its non-monetary uses,
Right.
which had monetary effects. So it'd be really annoying if the money you're dealing with has shocks always associated with it for something completely outside of its function as money. And then that's causing you problems with it functioning as money. And that would be one of the major benefits of having something like Bitcoin with, pure monetary uses, where there's no supply shocks that are going to be coming in because of that.
Here's my take on that. When I think about that, and I understand the argument, but then I think about the creation of the Eurodollar market back in, let's just say, the 1950s, as a result of there not being enough dollars outside of the United States to facilitate global economic growth with these, let's call them, emerging markets and whatnot. And that was pretty much the Eurodollar system, figuring out, okay, we don't have any dollars, so we've just got to figure out a way to create them. And hopefully they're fungible, but we don't have any green pieces of paper. So it's a cashless, reserveless system that all of a sudden now is cranking out whatever it is, $100 trillion. and so my point there is, in thinking about a Bitcoin standard, or even a gold standard for that matter, I think we've got to see it through the lens of the global economy, and not just centric to the U.S. domestic or any domestic economy. That it needs to have that functionality to expand beyond borders. So then, going back to the point of the supply shock, I think about the David Hume. I think he was a good buddy of Adam Smith, and he had a concept that he called the price specie flow mechanism. And it's pretty simple, but basically, if you're two countries, and one of them it has a trade surplus, they're going to be receiving all of the gold or the Bitcoin, let's say, not all, but that they're going to be receiving that from the country that has a trade deficit. And this is going to effectively increase the money supply. within that, or a supply shock, or an inverse supply shock. And therefore prices are going to go up pretty dramatically. And therefore that's going to make them less competitive on the global scale, or at least relative to their trading partner. And all things being equal, the trading partner's prices are going to go down, which is going to make them more competitive, which is going to allow their exports to increase, and then have some of that Bitcoin that went over to country A go back to country B over the next few years. And so now this is all theoretical, because in practice, you've got political things, you've got regulations, you've got taxes, you've got all these things, and then you've got the local currency creation that was being produced by the banks as fiduciary media at a local level, which had a significant impact, along with, in some cases, central banks raising and lowering interest rates.
Yep.
But just from a theoretical standpoint, I think there could be these types of supply expansions, and the same decrease in supply rapidly, even with a Bitcoin standard. Do you have any thoughts on that?
So like when you're saying supply increases, you're saying like on a Bitcoin standard, let's assume, there's no intermediaries. It's just Bitcoin traveling around, people trading with each other. So you're saying that within one geography compared to another, if they're trading with each other, that, their assets are going to leave, or the goods and services they produce leave, and then Bitcoin goes in, and that's just like increasing the amount of like Bitcoin within that geography.
Correct.
Yeah. I mean, I agree. I just think that like, that's just a natural mechanism of trade that will exist, and you become more capital intensive, and that's value.
Yeah, but I think that you can get that supply shock, if you will, maybe not in aggregate total.
Yeah.
But you can get it at a local level and within domestic economies that could have the same type of impact.
Right. There's always going to be any sort of business cycle risk that exists. And, from like the Austrian perspective, if it was just a pure full reserve, there's always going to be business cycle risk. It's just, the argument is it's better to let that get flushed out by the market than, have some sort of intervention or whatever it is, which I agree with. I think the major advantage is that if we have high information transparency and well-functioning credit markets, those can allow us to weather the storms of these different business cycles that naturally emerge. If you live within an economy, if you're in Taiwan and there's some massive hurricane and a bunch of semiconductor plants get shut down, then it would probably be good to have the ability to finance the rebuilding of those with credit, so that there doesn't have to be some drawn out bankruptcy scenario or whatever it is that would ultimately have that economy get shut down for a significant period of time, which is the advantage of credit. I think where people the pro fractional reserve people go wrong is by making the elastic money argument for that, and that how that allows it to weather the cycle, which is true. Elastic money does allow those economies to weather that cycle. I just think that applying this to Bitcoin, it doesn't have to exist through elastic money. It can simply come from, loanable funds of Bitcoin that exist. And that may come domestically, to your point. There might be some sort of excess amount of Bitcoin that exists and a lot of savers within that economy. So maybe it comes domestically, or it has to come internationally, in which case it would be very easy to do that on a network like Bitcoin, which opens up the rails of capital allocation to be, less geographically centered.
Yeah. Well, let me ask you the same question, but a little bit different way here. Do you think it's possible for an economy in the short term to run on all 8 cylinders with full reserve banking?
I would say yes. I think it is possible. It's just, to my point earlier, like to me, right? Like, that's a relative question. It's just like, what is all 8 cylinders? What is value? It's this value is this idea that's, defined differently between different people.
Let's just say that creating maximum amount of goods and services.
Well, it's just like, then the question becomes sustainability, right?
Right.
Yeah. So,
that's why I said short term, because, I think that's where you get into that cost benefit analysis.
Yeah.
But I just want to make sure that people understand,
Got it.
At least my view is that if you did have full reserve, I'm not saying that it wouldn't be optimal. I'm saying that most likely the free market wouldn't choose that, but just theoretically speaking, it may be optimal over the long run because it eliminates the boom bust cycle, misallocation of resources, malinvestment. But we have to understand that over the short run, that would be a cost, that it would limit the creation of goods and services to a certain degree.
Yep, yeah, and I completely agree with that. It's just yeah, in the short term, we could say that having a full reserve system means that there's this theoretical limit of the amount of credit that could ultimately emerge. Right, it is the amount of reserves that exist, at least within the banking system.
Mhm.
The key distinction is that there's like kind of like um, non-monetary transactions of credit that'll exist. Like a good example is like at the corporate level for like accounts receivable and accounts payable. You know,
That's ledger money. Yeah,
exactly, like the
that's
ledger-based
right. And then
systems,
that
yeah.
ledger money gets
Yeah.
used as IOUs, and you expand the money supply.
Right, right. So like
Yeah,
another form of
yeah.
IOU, or maybe you're having a hard week and your buddy Bill down at the bar, says, "I'll give you a free beer and you get me next
Exactly,
time around,"
exactly.
whatever it is. Like so like that also still exists. So like that being said, once again, that's kind of relegated to trusted relationships in the
Yep.
peer-to-peer economy. So it's that is also kind of a limited area, but within the full reserve system, you're limited by the amount of reserves in the system. Therefore, it's a more limited system than fractional reserve, where fractional reserve you're limited by the solvency of the institutions that broadly exist within the system. So
Yeah.
as long as they don't go bankrupt, they can keep expanding credit.
And I
Um,
want to add one thing to that. And even under the fractional reserve system, if it's backed by gold, the what we have seen in the past is when you look at the global economy, is that the only limiting factor is counterparty risk. That's it. Because you get into this situation where the banks can quite literally create as many currency units or IOUs as they want with no reserves, with zero, nada, nothing. And in the marketplace doesn't call them out on it. And they haven't been calling them out on it for the last 70 years. Not to say that it's a good system, not to say it's a good system, but this is what we have seen as a result of the free market, by the way, to get around that the scarcity of money, and to create a money supply that's even more elastic, so that global economy could function to the highest level that was perceived by the people that were participating in it.
and when you say that, you're referring to like fractional reserve fiat central banking.
No, the Eurodollar system, it's reserveless. So
Oh well,
there,
yeah, sure, but I mean we're under a global fiat system among central banks.
yeah, but I don't know that I mean, this takes us way off topic, but in my view, especially when you look at the global monetary system, the central banks, they really don't play a big role as far as the amount of currency units that are circulating. So, as an example, I think if you took a chart of the Fed's balance sheet, I don't think that would coincide with a chart of the global amount of dollars that are circulating. I don't think there's a relationship between the two, because I think that although the government can create more currency units if they're deficit spending that's being monetized by the Fed, as an example, I think that's just a drop in the bucket compared to the amount of currency units that are being created and destroyed in the global monetary system by the extension of credit, and then those loans being paid back. With these banks, they're representing 90%, let's say, of the total dollar creation or the total dollar supply. And so, anyway,
Yeah, I agree, but I think that like that system is predicated on its emergence and its the ability to perpetuate it is predicated upon central banks existing. Like during the crises, we had swap lines opened with international central banks to allow that to like continue to function, and private credit is how it's created. We can they create reserves within the system, and it's up to the private banks to whether or not they want to expand it, but none of that's possible unless we have the ability to create fiat central banking, which
that's a great point, Eric. So I should have said that this is a system that was a product of the free market up until, I would say, maybe definitely the GFC, but then maybe I would argue long-term capital management was kind of the central banks getting involved there, where in the past that would have been just something of the free market. So I should have said that from we'll call it 50 to, just to be round number, the GFC 2007, it was a system of free market. But then since 2007, to your point, it's definitely been propped up by the central planners. That's for sure. So do you have a couple more minutes? I don't want to take up too much of your time, Eric.
I love talking about this. We got all day, man.
Okay, cool. So let's go back and tug on that thread a little bit, because you had a very interesting point about the adoption of Bitcoin. So, and I think that is the one thing I always say, that regardless of the price, I think it's prudent to have some Bitcoin, or especially gold, outside of the banking system, to have some purchasing power outside the banking system. And, when you look at Russia, it's not like all these other countries, even though they're friendly to the United States, are completely ignoring that. They're looking at the United States and saying, or the West, and saying, hey, if they freeze Russia's assets, who knows? Maybe in 5 years, 10 years, they'll do the exact same thing to me. So we better, kind of start getting rid of these treasuries here, or anything that's denominated in dollars. There's a counterparty risk, and we just got, a cold shower in counterparty risk about 6 months ago. So let's start moving to gold. We see the central banks, big buyers of gold. And then we see a lot of countries, these BRIC countries, moving away from the dollar. But that might be, from the what's the saying, from the frying pan to the fire, or something like that.
Yeah.
But then your arguments that, okay, maybe they'll start incorporating more Bitcoin onto their balance sheet as well. This would increase demand. If it increases demand, then you're going to see the price most likely go up, especially considering the fact that majority of people are holding right now are probably hodlers, and therefore there's not much float out there for sale. So the price goes up pretty quick. As the price goes up, it starts to stabilize, because now, instead of the hot money coming in, which I would argue Wall Street was with Bitcoin, now you've got these central banks that aren't trading it like Shibu Inu or something like that, where they're going to be long-term. They're going to be basically hodlers.
Yeah.
And so this is going to, over the long run, create a more stable price. Then, as we know, human beings have recency bias. So if they see the price of Bitcoin gradually going up, and then just becoming more and more stable, then they think to themselves, well, wow, why shouldn't I keep this on my balance sheet as a reserve asset? So that creates more and more adoption. People get more acclimated to Bitcoin, and that's when they start transitioning into using it strictly as a digital reserve asset, or a digital asset, to something that's more transactional. And then once that takes over a small network within a community, then maybe we get to the point where the shoe company, or at least the retailer, decides to start pricing their shoes in Bitcoin, because they don't want to just sell it in Bitcoin to trade it for dollars. They want to just go ahead and sell it for Bitcoin to keep the Bitcoin, because that's what they want their savings denominated in. And I'm just trying to do my best to kind of think through the step-by-step process. So what do you think about that?
Yeah, I think that that's right. I think there's going to be all these incremental steps, and you have to think about it at the micro level, and how individuals are making their decisions, and how that all, any form of adoption will gradually start it to expand. It's likely to initially come through this institutional level movement. But what I also think is interesting is the peer-to-peer hodler economy that's building out, and how that's probably like the crux of all of it. It's the most important thing, because I talk about these things like fractional reserves and institutions, and there's a lot of things that could go very wrong for Bitcoin along the way because of these ideas and institutional adoption. When it comes down to self-custody and how important that is, the way that I think about it is, we need a group of, we need a diehard movement of people who are like, I'm holding my Bitcoin in a way that nobody's ever going to have control over it. And I'm holding it for the next, 20, 30 years, until we're in a hyper Bitcoinized world. And I can go build a citadel or something like that. That type of movement is so important, I think, to its growth, because that ultimately creates a deterrence mechanism against any sort of sovereign coercion over it. So it's like, we have these nukes in the US so that we don't have to use them. And that's kind of the idea, is like, we want to have this peer-to-peer economy built out, functional, and, have the ability to do it. It may not be as practical as using some other services and intermediaries, but it's always going to be there. And it's going to be really important to have that to deter institutions from trying to take advantage of this and just turning this thing back into gold 2.0, turning it into a CBDC on top of that. And then, some new form of fiat central banking where like all the Bitcoin's controlled by, institutions and nobody can actually permissionlessly move it around anymore. That's kind of like the doomsday scenario that I see for Bitcoin. And I think it's really important that we have this peer-to-peer economy still get built out and tools get built out for that so that we never end up there. But yeah, from the monetary growth perspective, the institutional adoption is going to be huge. I think the key thing here is like, if there's one thing I've been surprised about since I've gotten involved in this industry, it's just how much the stars have aligned for it over the years, and how at a geopolitical level globally, how things are. It seems like fiat is finally coming to an end, and there isn't too much. We're between a hard place and a rock with what we can do as a global, central bank, and there isn't too much more run. There's not a lot more runway that we have anymore, and because of that, I think the timing could be sooner rather than later for a lot of these things. And I don't know how much more drastic it's going to be with the US, but where I get, at the beginning of this year, I read Geopolitical Alpha by Marco Papich, just because that's one area where I don't have a lot of knowledge and I wanted to kind of get up to speed, which I recommend that book to anybody. It's a great way for people in investing to get up to speed on geopolitics and really understand it. Since I read that, when I hear podcasts and people discussing it, he highlights a lot of mistakes that people often make in their thinking process, and I thought it was really valuable. But anyways, he talks about thinking about from a perspective of how are other countries constrained rather than what do they want, and I think like a lot of these things come down to geopolitical issues that are, number one, hard to understand. Number two, we lack a ton of information transparency around what a lot of economies really do think and what they really are constrained by. We know a lot of things, but I think that how quickly some of this emergence comes and how quickly we get there will boil down to, do the East and the West enter some sort of war in the next 5 years? And if that happens, money printers turn on. And if that happens, when this all ends and the dust settles, who's going to be the most dominant power? Is it going to be a lot more dispersed globally? And if so, how badly have we destroyed the value of the dollar in that process? And just how much more have we opened up the playing field for alternative systems when the US is no longer protecting trade routes on behalf of other economies? So like that, there's all this complexity around all that, but I could see that being, there's a lot of scenarios geopolitically that could really open this up to be like, a fast growing state for alternative digital systems.
Yeah. And, ironically, I think that's a much different question from as someone that lives in the United States and your expenses are denominated in dollars versus someone that lives outside of the United States that their expenses are denominated in yen or British pounds or euros. Because as an example, if you look back at the last year, if you were to hold a treasury denominated in dollars as a U.S. citizen, you're taking a haircut right there. Sure, you might get 4.5%, but the inflation rate is, let's just say, 9, make the math easy. So you're losing 4.5% of your purchasing power. So especially at the long end of the curve, everyone, rightfully so, says, why on earth would you hold a treasury? And to your point, the more of these currency units that are created, we have these supply chain disruptions on top of the currency units, and this makes the inflation rate go higher. We have an inflationary decade in the 2020s, whether it's the 1970s or 1940s. This really promotes or incentivizes the adoption of another alternative like Bitcoin that is perceived as a deflationary money, at least a fixed money supply. But that's a different equation from the Japanese pension fund that is holding the treasuries on their balance sheet, absolutely loving life, saying, hey, our local inflation rate is, I don't know, let's say 2-3%, something like that. The dollar has gone up by 40% or something relative to our local currency.
Yeah.
And plus we're getting paid 4.5%. So it's weird that I think that as Americans, we say, yes, this is going to create this collapse in fiat currency, and it's going to drive all this adoption to either gold or silver or Bitcoin or whatever. But that might happen a lot later in all
Hmm.
of these other countries that see the dollar as this basically a wrecking ball that's coming through their entire economy and unfortunately wiping out their productive capacity at some level, but also giving them an opportunity to hold dollar assets and really increase their purchasing power at a local level, which is all they really care about, you know?
Yeah,
So how do you think about that?
I agree. It just, I don't see, I agree to your point. Like that is definitely a catalyst that could push off some of these other drivers in the long term. To have an answer around where I think it all nets out, I'm not sure. Just
Yeah.
it's not persistent that the dollar could continue to have that effect for the long term. So but I agree, it could definitely push it down the line.
What do you think, or have you given much thought to this the network effect, if there is one,
Mhm.
of dollar denominated debt being created and therefore creating future demand for dollars, especially if the velocity of those dollars starts to decrease because, let's say, of a global recession. And I've tried to give a lot of thought to not just Bitcoin, but any other currency taking out the U.S. dollar. And a lot of what it boils down to, in my mind, is the fact that the dollar is so darn cheap. Look at Argentina, look at Colombia, where I'm right now. 35% of their sovereign debt, approximately, is denominated in dollars. Why? Because they can issue dollar debt at what, 5%, or if they
Mhm.
issued peso debt, it'd be at like 15. So
Mhm.
they lever up on dollar debt because it's so darn cheap. But then, of course, that creates more demand in the future for dollars. And this BIS report that I referenced earlier, they're showing how this dollar-denominated debt, when you look at the on and off balance sheet, can be close to $100 trillion right now. And you know how the money system works. If we have less velocity, that's less cash flow to pay off those debts. And therefore, what you have to do is you just have to start taking the currency that's on your balance sheet and basically selling that to buy the dollar to pay off the debt, which creates the value of the dollar going even higher against those other currencies. And
Yep.
then the real inflation conundrum just really revolves around the United States domestic economy, because those are the individuals whose expenses are denominated in the dollars that are actually losing purchasing power relative to goods and services.
Right, right. And yeah, because we could have more private credit get created, but when there's an international demand that keeps consuming all of it, um, it causes, that can suppress like the dollar denominated level of like inflation that's actually emerging.
Yeah, like there, the typical thing you look at is like the twin deficits,
Hmm.
like the budget deficit, the trade deficit.
Yeah.
And you look at that and you say, okay, my gosh, $100 billion a month is leaving the United States and circulating throughout the global economy. And that seems like a huge number. But then when you think about it in terms of this global dollar denominated debt and the amount of cash flow is decreasing, assuming velocity is slowing down to a global recession. That's a big assumption. I'm just using that assumption based on the bond market right now and the inversion of the yield curve.
Hmm.
So you have the dollar cash flow decreasing to pay off that debt. So my point is, even if we're running these $100 billion trade deficits, that 100 billion is just a drop in the bucket, just a drop in the bucket, and it isn't enough to service that. Therefore, the only option that the widget maker in Vietnam has is to sell any currency they do have on their balance sheet or any assets they have on their balance sheet to buy the dollars, and then that creates more demand for dollars, more supply of their local currency, which drives the dollar even higher, again, relative to their own currency and potentially relative to goods and services in their own economy. But again, that doesn't apply to Americans. So
Hmm.
it's weird. It's just it's a completely different ballgame when you get outside of the US, where the expenses are denominated in a currency that is losing significant value. And therefore, it behooves you to hold a lot of your balance sheet in dollars, which creates future demand.
Right, right. And I wrote a piece on this earlier this year, kind of just covering the international reserve situation and making the point to people in the Bitcoin community of just how deeply entrenched the dollar is at a
Yeah.
global
Yep.
level, and how
Yep.
that's a self-perpetuating scenario. I think where a lot of that, to the point I was making earlier, where a lot of that all of that was predicated and all bootstrap based on military power, us
Mm,
becoming the dominant military force, and the petrodollar system, and entrenching that very deeply, which led to all these other knock-on effects. And if we have, to my point earlier, like, if depending on what happens with the US as a military force at a global level, that's how I could see that start to unwind. If
mm,
if something happens the next decade, we have a major war, and we don't have the same amount of, we don't have as much to offer. Hey, you guys, trade oil in dollars, and we're going to protect your trade routes.
yep. Yep.
If the eastern side, that starts to change very significantly, and maybe China emerges on top, the actual idea of a petro yuan is a little bit higher now.
Yep.
And
Yep.
and that's a very simplified explanation of it, but like, that's kind of what I see. All that system boils, or a lot of that system boils down to it. It's all predicated upon military exchange, and
Mm.
an event that, if that could uplift it if that starts to unwind at some point.
Great point. Great point. Yeah, I completely agree that. And guys, just to kind of sift through this this argument here, you've got the my thing that one of the things that drives uh, demand for dollar debt, when I think it through, is the fact that so many of the input costs are settled in dollars.
Yep.
Because that's what we're pricing commodities in. But to your point, if the dollar starts to lose that military power, then all of a sudden Saudi Arabia says, "What am I doing this petrodollar thing for?" When the agreement here is that you provide military for me, and I settle the oil transactions in dollars. But if your military is like look at Afghanistan, that's what I'm getting. And
Right.
so they say, well, no, I'm going to start denominating or settling this one input, this one massive input to global goods. I'm going to start settling this in yuan or whatever it is, pick your currency. And then all of these other manufacturers in Vietnam, let's say, they say, oh, shoot, well, now I don't need to hold as many dollars on my balance sheet, and I don't have to borrow those dollars to get that oil. Now I can go ahead and borrow in yuan. But there again, that takes us back to that. What's the price of the money? What's the price of the debt? And ironically, I think that what may get us off that dollar standard, if you will, faster is China's central bank digital currency. And I'm not saying I like this by any stretch of the imagination, but a central bank digital currency is
Right.
unique in
No,
the
that's a
sense
good point.
that their balance sheet is unlimited. And since their balance sheet is unlimited, they could undercut the price that the free market would set on the dollar debt. So they could issue them yuan debt at like 2% and undercut the euro dollar's ability to provide that dollar debt at like 3 or 4%. So, but that is a key component, I think, of a potential transition. All right, Eric, I've kept you long enough, buddy.
I definitely agree.
Yeah, so let's shoot over to your paper here, which I think everyone should read. Let's see, we've got Josh. Can everyone see this?
Everyone can see it. You just need to make it full screen.
Okay. Well, I can't make a full screen, or else then it kind of distorts it. So, Eric, where can people find this? Because I think it's just imperative that they give this a look.
Yeah, the big thing is just follow me on Twitter, and that's just my name, and right down there. And on my Twitter, I got a link to my website, and I post all the stuff in my blog. So that's the full banking versus free banking paper on my blog, the one at the top.
And I cannot recommend it enough. So, Eric, I appreciate you coming on and going over all these ideas, and just good luck with it. Keep writing, man. Keep writing, because the world needs to hear what you're saying. That's for sure. And I'm sure we'll talk again soon.
Yeah, absolutely, George. Thanks for having me on. This is, I think we're talking about, all the right questions in the industry. And, I think it's good when people dig into a lot of these, and it brings the Bitcoin movement forward in the right way and, a thoughtful way. So yeah, thanks for having me on. I love talking about it.
Yeah. Have a good one, buddy.
See ya.